IAS 33 earnings per share was issued by International Accounting Standards Board to prescribe principles for calculation and presentation of earnings per share. This standard sets out a uniform approach towards calculating the denominator of earnings per share formula, which allows shareholders to make comparisons between the performance of two entities. All the companies that are listed or are in the process of being listed on stock markets are required to follow this standard for the calculation and disclosure of earnings per share in their financial statements. There are different types of shares: ordinary shares, potential ordinary shares, and preference shares. Ordinary shares are common stock, an equity instrument which is subordinate to all other equity instruments. Potential ordinary share is a financial instrument or other contract that allows its holder to acquire ordinary shares. Preference shares are shares which are preferred over ordinary share for dividends. Preference shares can be divided into two subcategories. Non-cumulative preference shares provide shareholders with fixed dividends and are not accumulated with the next year dividend if they are not paid in the current year. Cumulative preference shares are shares that also provide shareholders with fixed dividend, and if they aren't paid in the current year, they are accumulated and paid with the next year dividend. Few examples of potential ordinary shares are convertible debt, convertible preferred shares, share warrants, share options, share rights, employee stock purchase plans, contractual rights to purchase shares, contingent issuance contracts or agreements, such as those arising in business combination. Basic earnings per share is calculated by dividing profit or loss attributable to ordinary equity holders of the company by the weighted average number of ordinary shares outstanding during the period. The earnings numerators should be after deducting all expenses including taxes, interests, and preference dividends. Dividend on non-cumulative preference share is deducted from net income only in the period it is paid, otherwise there will be no deduction. Dividend on cumulative preference shares is deducted from net income in the period regardless of whether it is paid or not. And the amount of preference dividends for the period does not include the amount of any preference dividends for cumulative preference shares paid or declared during the current period in respect of previous periods. For the ordinary shares issued at market value, the weighted average number of ordinary shares outstanding during the period is the number of ordinary shares outstanding at the beginning of the period, adjusted by the number of ordinary shares bought back or issued during the period multiplied by a time weighting factor. The time weighting factor is the number of days that the shares are outstanding as a proportion of the total number of days in the period. A bonus share issue, also known as a scrip issue or a capitalization issue, occurs when a firm gives more shares to existing shareholders in proportion to what percentage of the firm they currently hold. They are often given out instead of dividends and no economic benefits enters the company. There is no change in entity's resources. Rights issue occurs when a firm gives more shares to existing shareholders in proportion to their current holding, at a price lower than the market value of shares. Therefore, rights share contains both bonus element and market value element. Bonus shares and bonus elements are directly added to the denominator of earnings per share formula as they are assumed to exist from the beginning of the period. They are also added to the denominator of previous year's earnings per share formula in order to calculate restated earnings per share. In case of rights issue, weighted average number of ordinary shares, denominator, is adjusted for two elements. When dealing with bonus element, the number of shares outstanding at the beginning of the period should be multiplied with bonus factor to calculate number of shares in issue before the right issue. It is weighted up to the date of rights issue. Bonus factor equals to actual share price before the issue divided by theoretical share price after issue. For the market value element, the number of shares in issue after the rights issue is weighted for the period after the rights issue to the year end. Add number of shares from both of the elements to find total weighted average number of ordinary shares. This will be further explained in example question at the end. According to the standard, dilution is a reduction in earnings per share resulting from the assumption that convertible instruments are converted, that options or warrants are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions. For calculating diluted earnings per share, an entity shall adjust profit or loss attributable to ordinary equity holders, and the weighted average number of shares outstanding, for the effects of all dilutive potential ordinary shares. Few examples of dilutive potential ordinary shares are shares that will rank for dividend in future. Loan stock or preference shares convertible into ordinary shares at a future date. Share options and warrants enabling the holder to subscribe for equity shares. Potential ordinary shares are dilutive when after their conversion to ordinary shares, no new economic resources enter the company, which means that a bonus element will be present. To achieve a more holistic understanding, we will solve a question, and see how EPS is calculated. You can pause the video to read the question, and then move ahead. It is important to note that the profit is before interest and tax. At times, the figures are given for net income. Read the question carefully and be mindful of such distinctions. We are required to calculate the following: the basic EPS for 2020 and 2021, the restated EPS for 2020 after bonus issue, and the diluted EPS for 2020. We will go through the detailed calculation for each. To calculate basic EPS, we must first calculate profit after interest, tax and preference dividends. To do that, we take profit before interest, tax and preference dividends, reduce the interest payable on the 9% bonds, adjust for the tax that is to be paid, and, finally, subtract the preference dividends to be paid for the year. Once we have calculated profit after interest, tax and preference dividends, the remaining calculation for basic EPS is pretty straightforward. We simply divide the profit after interest, tax and preference dividends by the number of ordinary shares outstanding. In 2021, there was a bonus issue of 300,000 shares, which we assume existed from the beginning of the period. We simply add them to the denominator. The basic EPS comes out to be 1.73. For calculating restated basic EPS for 2020, it is important to remember that bonus shares are directly added to the denominator of EPS formula, as they are assumed to exist from the beginning of the period. They are also added to the denominator of previous year EPS in order to calculate restated EPS. That is exactly what we will do. In the equation that we used to calculate basic EPS for 2020, we add the 300,000 bonus shares that were issued in 2021 to the denominator, and solve the new equation. The resulting restated EPS is 0.89. Now we go to the tricky part, that is calculating diluted EPS for 2020. We'll break this up into small segments, to help us better grasp the concept. For diluted EPS, both convertible preference shares and convertible bonds are potential ordinary shares. To find out the diluted EPS, we will assume that both bonds and preference shares are converted into ordinary shares. Due to assumed conversion of bonds, interest will not be payable, resulting in increase in income but having a negative tax impact. Preference shares will result in increased income only, as dividend is always after tax. To calculate earnings for diluted EPS, we start off with profit after interest, tax and preference dividends. Add preference dividends paid during the period. Add the interest paid during the period. And, subtract the additional tax that would be paid as a result of the increase in net income arising from the interest being added back. Doing so, we arrive at our required earnings. As there are two potential ordinary share instruments, we'll need to do a step-by-step dilution to avoid anti-dilution. Anti-dilution happens when the adjustment for a potential ordinary share instrument increases the EPS instead of decreasing it. This could potentially misstate the EPS, but the question is, how do we know which instrument to take first? The answer is simple, we form a priority list. The priority list is formed by calculating the per-share impact on earnings of each potential dilutive instrument and preference is given to the one with lowest per-share impact. You can calculate this by listing the increase in shares and the impact on earnings, as a result of converting the potential ordinary share instrument. This is done for each instrument. Divide the impact on earnings by the increases in shares. You will arrive at a per-share increase in earnings for each dilutive instrument. The lowest takes precedence. Which means, in step-by-step dilution, first, we will take preference shares and they will be followed by convertible bonds. Finally, to calculate the diluted EPS, we will start off with our basic EPS. Adjust the impact on earnings and shares of preference shares to calculate step 1 of diluted EPS. Then we adjust the impact on earnings and shares of bond conversion to arrive at our final diluted EPS. In this example there is no anti-dilution, but in case the adjustment for an instrument increases the diluted EPS in any preceding step, we ignore that instrument and take the lowest diluted EPS from the list as the diluted EPS for the year. Now, we will solve the example of a right issue, and understand how to make the necessary adjustments to account for it. Pause the video and read the question. To calculate weighted average number of ordinary shares in case of right issues, we need to adjust for market and bonus elements. To calculate the bonus factor, we will first calculate theoretical share price after the rights issue. Bonus factor will be equal to market value of share before the issue divided by theoretical share price after the issue. Then we make a timeline for the year and the number of ordinary shares outstanding at the beginning of the period multiplied by the bonus factor or weighted to the date of rights issue. Number of ordinary shares after the rights issue is weighted from the date of rights issue to the end of period. Both are added to calculate total weighted average number of ordinary shares. Finally, basic EPS is calculated after subtracting preferred dividends from net income and dividing it by total weighted average number of shares. In the end, we'll highlight the disclosure requirements of IAS 33. IAS 33 requires the entity to disclose the following in their financial statements: the amounts used as the numerators in calculating basic and diluted earnings per share, the weighted average number of ordinary shares used as the denominator in calculating basic and diluted earnings per share, and instruments that could potentially dilute basic earnings per share in the future, but were not included in the calculation of diluted earnings per share because they are anti-dilutive. That will be all for IAS 33. Thank you for watching.